This is Cost Volume Problem Set 1, Introduction to Cost Volume Profit. Here are 4 questions, and the first one is Shopping Thrills Company reported the following results for the month of November. Now you can download the template and do these problems and then check the video. Here for Shopping Thrills we have the CVP income statement. Sales minus variable costs, contribution margin minus fixed costs, net income. Now management is considering the following independent courses of action to increase net income. Number 1, increase the selling price by 8% with no change in total variable costs. And number 2, decrease fixed costs by 20%. So now the first one, increase selling price by 8%. Now we're not increasing the volume, just the price. So instead of 400, we're going to get 8% more in sales. Now, we always reference other sales when we do this. So therefore, in the first case, here we're going to be looking at sales, which is 400,000 times 1.08%. So revised sales then would be 432,000. The variable costs will be the same. So therefore the contribution margin is 212,000. It's gone up by 32,000. And then the fixed costs will remain the same in this alternative. Therefore the net income has increased by 32,000. So option 1, we are better off than the way we are now by 32,000. So let's investigate option 2 now. We're going to leave sales the same, and we're going to look at the variable cost being the same, the contribution margin the same as we are now, but we reduce the fixed cost from 80,000 down to 64,000. We do that by multiplying the fixed cost by 80%. And therefore the conclusion here is that option 1 is better than the way we are, and it's better than option 2. So our best strategy then should be to increase the sales price by 8%. In the month of June, Doe Company sold 400 widgets. The average selling price was $24 per widget. During the month, fixed cost was $4,320, and variable cost was 40% of sales. Now, first question is, they want us to determine the total contribution margin in dollars, then the contribution margin per unit, and then the contribution margin as a ratio. So to begin with then, total contribution margin, we need total sales minus total variable costs. So total sales then, sales would be 400 times 24. And then variable costs now, they said the variable cost is 40% of sales. So we take 40% of 9,600, and that's our variable cost. Contribution margin is the difference between those two. Now the contribution margin per unit, we need the selling price on a unit basis, and that would be $24 minus the variable cost, 40% of $24, and that gives us a contribution margin per unit. Now as a ratio, we can either take contribution margin as a percentage of sales in total or on a unit basis. So therefore, first case we'll do it in total. Contribution margin in total is 5,760 divided by 9,600, and by unit it'd be 14.4 divided by 24. So there we have the contribution margin ratio. Next they want the break-even in units. Well, the break-even in units is going to be equal to the fixed cost divided by contribution margin per unit. And so the would be 300 units. If I want it in dollars, then it would be fixed cost divided by contribution margin percentage. And the answer then would be 7,200. Total variable costs, well, that is simply variable cost per unit times the break-even units of 300, and total variable cost then would be 2,880. Oak Hammock Company developed the following information for bucket sales: selling price, variable cost of goods sold, fixed cost of goods sold, variable selling, variable admin, fixed selling, fixed admin. For December 31st, they produced 1,500 buckets, and they're asking us to prepare a CVP income statement. All right. Well, the first thing then is sales, and that's straightforward. Sales is simply the selling price times 15,000 buckets. Now, the variable costs. Now, here we have three variable costs. The variable cost of $1.50 per unit, 10% of selling price, and 25 cents per unit for variable administration expenses. So when I do the variable costs, then notice the formula up above, and I come up with 36,000. The difference is my contribution margin, 61,005. And the fixed costs. I have three fixed costs: fixed cost of goods sold, fixed selling, and fixed admin. So when I calculate those three together, it's 33,000. Therefore, my net income, what they're asking me for, is 28,500. Gloria Meehan is considering opening a window tinting business. Each window tinted takes 4 square feet of tint. Gloria anticipates the retail price to be $35 each per square foot. She estimates that the following costs will be incurred during the month during operations: $35 rent, $3,000 depreciation, wages, and so on. Determine the variable cost. Well, the variable cost is simply the square feet of 4 times $3 per square foot. And the total variable cost, a fixed cost, we simply add the rent, depreciation, and wages. Now, we're going to go one more step, and that is we're going to consider the contribution margin per unit, and that is selling price minus the variable costs. Now, B part, determine the break even. Well, that's simply fixed costs divided by contribution margin per unit, and we get 500 units.